Hi, welcome to the next lecture of Financial Statement Fundamentals, how to understand the story of any business at any time. This lecture is about the accounting equation and is part of the Accounting Foundation Knowledge section. Alright, so what is the accounting equation? In short, the accounting equation is A equals L plus E. Or without the acronyms, it's assets equals liabilities plus equity. I'm going to leave those two formulas or equations at the top of the screen for the rest of this lecture. So just remember them, they're very important. And the accounting equation is at the heart of double entry accounting. And you have to remember that this equation must always balance. If something isn't balancing, it means there's been an error in your accounting. Assets, liabilities, and equity, part of the accounting equation, are the three components of the balance sheet. The balance sheet will be discussed later in the course. But just at this moment, keep in mind that the assets represent a financial value, for instance $100. The liabilities also represent a financial value, for instance $30. And equity, once again, is a financial value, of $70. The financial values must always balance. And that's where you get the balancing equation from. It's because they represent financial values. And if you think about it, that every transaction under the sun affects the accounting equation at least twice. And this is why it's called double entry accounting. So before every transaction and after every transaction, forever now and forever will be, the accounting equation must balance. That's very important. While debits and credits are not covered in this course, or at least at this stage, it's important to remember that every transaction will impact the accounting equation at least twice through these specific debits and credits. There must be at least one debit and at least one credit. And the debits and the credits will make the assets, liabilities, or equity, whichever one they affect, either go up or down. And the financial value of the debits must equal the financial value of the credits. So we've got these rules. A transaction impacts the accounting equation at least twice. It impacts the accounting equation through debits and credits. And the debits and credits make the corresponding assets, liabilities, and equity either go up or down. And the financial value of the debits must equal the financial value of the credits. Now, if all of these things hold up, this quality is what makes sure the accounting equation remains balanced. For instance, assets might go up and liabilities might go up. It'll remain balanced. Or assets might go up while at the same time assets come down. And that'll make the equation balance. It's these debits and credits impacting the equation that's making the assets and liabilities and equity go up and down according to their corresponding rules. Alright, so here's a quick example. Hopefully this will help a bit. We talked about debits and credits that must balance, and we talked about how the accounting equation must remain balanced. So we have Emily's engineering service, which is a business, buys an iPad with cash. So we have a debit, the iPad, which is a PPE asset. PPE stands for property, plant and equipment. So we debit the iPad, $500, or we debit the PPE asset, $500. And we credit the cash, which is also an asset, for $500. So we have at least one debit, at least one credit, and the credits are equal to the debits, and vice versa. Alright, so if assets, liabilities, and equity are all balance sheet components, where do the profit and loss components fit into the accounting equation? Remember how we were talking about earlier on, there's the balance sheet and the income statement and the cash flow statement. Where do the profit and loss components fit into the accounting equation? After all, aren't some transactions just revenue and expenses, and they're part of the profit and loss? Isn't the accounting equation meant to capture all possible business transactions, not only balance sheet transactions? Well, in this case, and in every case, revenue and expense transactions and their respective accounts are part of equity. Revenue increases equity and expenses reduce equity. Alright, so let's go through another example. The Fifth Avenue Apple store sells an iPad to Emily and is paid cash. So this time we debit cash because they're receiving the cash, and that's an asset for $500. And then we credit the sales revenue, and that's part of equity, remember, and that's $500. So debits equals credits, one debit, at least one credit, and revenue is part of equity. Alright, let's do a quick check. Now, this whole course is about telling stories of businesses and how we use financial statements to tell stories. Have a quick think about it in your head. And before I go into my specific story, can you think of a story about these two businesses being Emily's Engineering Service and Apple Inc. and tell that story simply based on the most two super basic example transactions? I know they're not super basic to you at the moment, but just for argument's sake, they're possibly the first two accounting transactions you've seen with double entry accounting. And as you develop your accounting knowledge, you'll see that there are far more advanced double entry accounting transactions. So let's try and tell a story. Have a quick think about it. Alright, I'm going to read this out. This is my story. How about this? Emily is an engineer who wants to invest in equipment, PPE, that will help her engineering service business earn income. And since it's equipment that hopefully will generate income, this makes PPE an asset. She decides that she needs an iPad for all the cool engineering apps that'll help her generate that income. Now, she's a very new business and she can't get a credit card from the bank. And a credit card from the bank would be a liability. So she can't use a credit card to pay for the iPad. Instead, she withdraws cash, which is an asset, from her business bank account, walks down to the Apple store on Fifth Avenue, and pays for the iPad up front. The $500 Emily paid for the iPad is regarded as ordinary sales revenue, which is equity, by Apple, and they record the transaction in the till, which is electronically sent to the accounting system at their head office in San Francisco. Alright, so here's the conclusion to the quick check, or my answer to the quick check. On Emily's Engineering Services financial statements, there would be the PPE asset, which is the iPad, and that'll be shown in the balance sheet. The cash paid would also be shown in the balance sheet. It would be a reduction in cash in the balance sheet. And from the other side of the transaction, on Apple Inc.'s financial statement, the cash received would be shown in the balance sheet. Cash would be increased. And the sales revenue will be shown in the profit and loss statement, which is also known as the income statement. And that would be an increase in revenue. There would also be a couple of effects in Apple Inc.'s inventory, which would be balance sheet, and cost of goods sold, or COGS, which would be part of profit and loss. But this technicality will come a bit later in the course. And that long, detailed story came from a single iPad purchase. Imagine the type of story development from millions or billions of transactions being summarized in regular financial statements. Yeah, it's quite astonishing, but this might be a little too much accounting romanticism for you. Well, just run with me for a little bit. Here's some of the historical context of double entry accounting. Double entry accounting is hundreds of years old. It dates back to the year 1494. It was developed by an Italian Franciscan friar, and it was meant to reduce events, or in my words, stories. It was meant to reduce events to numerical abstractions, and it was meant to be accessible to each and every man. And today, double entry accounting just powers QuickBooks, Xero, and every other financial accounting software package you can think of. Every time you punch in some data through any one of their modules, the software is codifying that transaction using double entry accounting. And that's how you get your financial reports at the end of the period or at a set point in time. Thanks very much for your time, and thanks for the little indulgence with the history of double entry accounting and my long story about Emily and Apple. Thanks.